Welcome to today's market report.
Losses on Thursday knocked European shares 1.2% off all-time highs as a clutch of dismissal earnings and falling bond yields dampened sentiment, while UK-listed Avis soared 18% on merger talks. The pan-European stock 600 index slipped 1%, with the oil and gas sector falling 2.7% to a 6-month low. Siemens Energy slid 11.1% after scraping its margin target as Siemens Gamesa, its wind power division, was hit by higher than expected raw material and product ramp-up costs. Oil major Royal Dutch Shell and BP fell more than 2% as crude prices dropped on expectations of more supplies. Losses in Europe were broadly based, with economically sensitive stocks like banks, automakers, and travel down between 0.3% and 1.6% as investors grew wary of rising COVID-19 cases across the continent. Official data showed that the UK reported the highest daily increase in COVID-19 cases since 15th of Jan. A rally in bonds considered safer assets gave further evidence of market caution. There has been a little bit of a review of the growth story that we've all been expecting. According to Stanhope Capital, we can see that there is at some point going to be monetary policy tightening given inflationary pressures. The ECB and BOE are saying not yet, but it is clearly starting to come into conversation. They also added that the renewed increases in COVID-19 infections and restrictions are also having an overall impact on markets. Economic recovery optimism and a strong start to the earnings season had seen the Stoxx 600 hit a record high on Tuesday. UK-based cyber security firm Avast plc posted its best season on record after the company said it was in advanced talks on a merger with peer Northern LifeLock Inc. Analysts, however, warned against the euphoria. The UK's already very modest-sized technology sector can ill afford to lose one of its leading constituents. The current surge in takeover activity could have a materially negative impact on the breadth and diversity of the UK stock market. The FTSE 100 dropped 1.1%, with data showing the number of employees on British company payrolls surged in June by the most since the start of the pandemic. Online fashion retailer ASOS tumbled 18% after it said sales growth slowed in June and higher costs did not translate to higher prices for consumers. Sterling edged lower on yesterday after the Bank of England scraped pandemic-era curbs on dividend payments by banks, but warned some asset prices look stretched. BOE Governor Andrew Bailey said its stress tests showed the banking sector was well capitalized to cope with the fallout from COVID-19 on the economy. But the Bank of England also said in its financial stability report that some asset prices look stretched. The bank added it is keeping a close eye on the housing market and how fast rising prices translate into household indebtedness. Sterling eased to 138.20 against the dollar after jumping to a 2-week high on Monday. European Central Bank President Christine Lagarde told investors to prepare for new guidance on monetary stimulus in 10 days and signaled that fresh measures might be brought in next year to support the euro area economy after the current emergency bond program ends. Speaking to Bloomberg, ECB raised its inflation goal to 2% and acknowledged it may overshoot the target. Lagarde said the 22nd of July Governing Council session, previously expected to be relatively uneventful, will now have some interesting variants and changes. It is going to be an important meeting, she said on Sunday in Venice after a meeting of Group of 20 Femings and central bankers. Given the persistence that we need to demonstrate to deliver on our commitment, forward guidance will certainly be revisited. The unexpectedly early conclusion of the ECB's strategy review last week is immediately feeding into speculation over the central bank's plan as the Eurozone economy started to recover from the pandemic. The US dollar was up yesterday, but started a retreat from recent peaks as investors digested economic data from China showing a slowdown in GDP growth and the economic recovery from COVID-19. The dollar index was marginally lower at 92.35.
This is today's market news. Thanks for listening. We'll see you next time.